There we go. Hi, my name is Jenna Apgar with Business Growth Network, and we are here today with the Richardson Plano Networking Group, and we are going to discuss tax because it is that time of year again where you'll be wrapping up all your business tax forms. And we'll be working with Steve, who will have lots of great information. This is a Facebook Live, so please feel free to ask your questions down in the comments below. Even if it's after the live presentation, he will be happy to answer questions as they come. Feel free to share and tag your friends, turn on notifications so that you can get future trainings. And I will let Dave Roberts from Roberts High Performance introduce Steve. Bye.
Okay, how many of you, does everybody get one of these? I know, Karen, you didn't get one because you're not here, so I'll get you one in a second. For those of you who turned in last week, this is the second installment, so I'm excited not only for you guys to see this, but also for the people on Facebook Live, and also those who will watch it on the replay, so that's going to be cool. So we'll be sharing this with you. How many of you have ever filed taxes? Hopefully everybody, okay? Now, how many like me have ever had an IRS audit? Am I the only one? Oh, okay, all right, cool. Well, then if you've never had an IRS audit, then I would say that you're probably leaving money on the table. That's my opinion. That's not. I'm not talking to but I'm just saying that the thing is, there are a lot of things that you don't do because you don't understand. There's a lot of simple things that you can do that you aren't doing, and there's a lot of things like that. So, how many of you want to have a no tax year like Donald Trump? Okay. I'd like to be able to lose $900 million and then have to write it off over a bunch of years if I had $900 million to lose. But I've actually had that kind of experience myself. And let me tell you, it's not fun. But the fact that you don't get to pay a little bit of taxes isn't a bad deal. Okay? But it's not you wouldn't lose all the money you lose to write off. So anyway, I really respect Steve and his experience here. I've known of the Schlichting Group a long time before he became part of Richardson Plano Networkers because he advertised on a radio station I listened to a lot. And I don't know if I shared that with you, but anyway, so I would encourage you to listen to Steve. Sometimes tax people kind of tune it out, but this is really important, and this is the right time to be doing that so you can make those preparations. So Steve, if you would, let's welcome Steve to our Richardson Plano Networkers and Facebook Live.
Hey, thank you, everybody. I appreciate you for taking time out of your Friday to come listen to tax, because it's one of the least exciting things that's out there. And but we're coming on to the end of the year, and first and foremost, I got a little handout, and I love the Snoopy. It says, "Dear IRS, I'd like to cancel my subscription. Please remove my name from your mailing list." If it was that easy. But one of the things, let's just kind of flip it over. And I know it's a lot of small print, but one of the things, October 17th is the deadline if you haven't filed extension for individuals. And so, surprisingly, there's a lot of people that file extensions and wait until the very, very last day. We're getting to that point. And one of the deals is it's not a big deal if you have a refund, it's a big deal if you owe money. Because if you miss that deadline, whatever you owe, you're going to tack on another 25%. So it's one of the most draconian penalties you could have is by missing that extension deadline. But, one of the things, and Mel's not here today, but we've got some financial guys. One of the things that you can do that affects this year, the 2015 tax return, was you can set up a SEP, and it's a self-employed pension fund. And, it's a unique product. It's kind of like an IRA. But you can set up to $40,000 into it, and you can use it as a write-off, if your company's doing well. There's a lot of details that we've got into it. 25% of your compensation. So if you set up yourself as a W-2 individual, you can take up to that percentage, or up to, or actually $53,000 for 2015 and 16. And then, and it's got the same program. You set it up like an IRA, and, you make your deposit whenever you file your tax return. And so, like I said, you've got till the 17th to do that. And and you can deduct that into your savings and put it away for a rainy day. But let's get on to the 2016 items. And I'm going to try to start out with some, a SEP is a kind of a technical item. There's not a lot of things that we can do for 2015 other than try to get you filed by October 17th. Now, in 2016, we've got enough time here to sort of reflect and kind of look at what's going on in your world, if you're self-employed or if you're a small corporation. One of the things I really recommend is getting organized. Look at your returns. Understand your previous returns. Compare it to your numbers that you've got this year. Because that way you can understand if your estimates are right, if you're on par with everything. Are you having a windfall of a year or are things down? Because that can help you with some of your strategies going down the road. Because, the more organized you are, the more in tune you are with your business. And that's really a critical thing. I get lots of clients that come in and they got into something, it was a hobby, turned into a business, and now they're making a lot of money every year, but they don't understand even what they can deduct. And that can be very, it's a little difficult because there's a learning curve. And part of being in business for ourselves is learning. And the more you can learn, the more things that you can take advantage of to help minimize your taxes. And like Dave said, I'd love to have a zero tax year. It's not always easy to do. It's actually really difficult to do. But there's a lot of things that you can do that people just don't ordinarily think of. And you have to do it before December 31st at the end of the year. So if you can take advantage of between here and now, it really helps you out. But let's get on to that, getting organized. One of the things, create a chart of accounts so you understand your expenses, you understand what your fixed costs are, what your variable costs are. And then, if you look at your estimated payments and your withholdings, like I said, compare your other information from year to year to see where it's at. One of the things that I really talk to people about where self-employed people struggle is with quarterly payments. That's always tough because the IRS doesn't understand when you're self-employed, your income does this. And when it goes up and down, it's pretty hard to go, okay, I'm going to do a quarter of what I did and a quarter of what I did. What you can do is look at your tax return and with a little bit of, and I've got a different worksheet I can provide you, determine what percentage of your gross revenues end up being your tax liability. So that way you can total up your deposits at the end of the week and send the IRS a check for that amount. Because the IRS doesn't care if you send it daily, weekly, monthly, as long as you send it in before it's due. So one of the things, and that way it really works with, whoops, hey, your camera's kind of drooping a bit.
Oh, no, it's fine.
The
You got a
headless tax
notification. That was just a notification.
Okay. And, when it can determine that percentage, it's an easier process because it rides the ups and downs. If you have a really great week, you send them a little bit more. If you have a normal week, you send them about the same. And if you don't sell anything, you don't send them anything. But that way, it's one little hump that I've really learned that I've had people that have come in, they go, I've spent CPAs and attorneys and all this other stuff, and nobody really came up with that concept. And it's a small little tweak to help you really understand that really can get you as close to zero as possible. And that's a really nice little tool. But then one of the things is, if you're in touch with that, going into the end of the year, you can defer income. Those are one of the things because you've got regular expenses and you go, okay, here's what I'm looking at tax-wise, here's what I'm looking at income. Billing out and collecting that basically a week different. If you collect it in December, it's income for this year. If you collect it in January, it's income for next year. And it's just by adjusting your billing. Some of the things that you can do is accelerate some of your expenses. What are things that supplies that you need, equipment that you need? Those things can be written off. So it's going to bring the income and bring your taxes down. And so that way you can accelerate that for this year so you go into next year not having to buy those tools and that equipment or supplies. And it gives you a head up on really going into next year. It tries to set you up for the best thing. One of the things, if you do get a little aggressive, and it really does a lot with itemized deductions, A&T can sneak in. But that's when it really gets, it's a program that was created for a lot of people that were really structuring their expenses, and it could be kind of punitive in that because it'll balance out some of your property taxes and things of that nature. Question?
Yes. Can you explain alternative minimum tax?
We'd be here all day with that one. Basically, it's a rule system that was put into place for people that had figured out, because people are giving Trump a lot of grief, but had figured out in the system a way to really write off all of their taxes, but they really had significant income. And so what they do is they go, well, when you fall into AMT, you pay the higher of the tax, the one on the tax return or the one based upon their calculation after they phase out this information. And so, it can be really punitive. So, and that's kind of a fine line. But like I said, most of the time when you're self-employed, and unless you're making $500,000 a year, it's fairly uncommon for you to run into that. It's kind of like with rental properties. I've had people come in and they run rental properties at a loss, and they've got all these negative losses every year that they compile while they're building equity in the house, but the IRS will do a passive loss limitation, and so it can be phased out sometimes, and they have to carry that. Kind of like with Mr. Trump's losses, he has to carry that into the future because he can't take it all at once, because otherwise the government's not going to cut him a check for 95 for that $951 million. So he gets to carry that and keep track of that. One of the simple things that's really straightforward is employing your family. It's not a hard thing. If you've got a stay-at-home spouse, if they don't work, you can put them on a W-2 for about $3,000 a year, and that really qualifies them for minimum Social Security benefits down the road. On top of that, they get the child care credit, where it's fully deductible travel and fringe benefits while minimizing payroll taxes. So if you're going to conference or something like that, and education, your spouse can come with you, it's a corporate write-off. So those are little things that, trying to maximize those. Even with children, you can employ your children at age 6 with a reasonable income for work performed, even if they're sitting there feeding the shredder or cleaning the office.
Age 6?
Age 6. Age 6. And in that, and that's, I'd say it's a good thing to start putting it towards college fund. In that situation, tax deductible basis, each child could earn up to $6,300 tax-free. And they don't have to file their own return, and they're not going to owe any taxes on it, as long as you do the 940, 941, so you make some deposits for them. But in exchange for services rendered. And on top of that, establish and fund a maximum annual contribution of $2,000 a year to a Coverdell savings account, formerly known as an educational IRA, for each child to shelter investment earnings for future tax-free payments for college and or private schools. So all of this, there's little things that you can do while they're young, and it'll sit there and accumulate and help with that. And then also you can do a 529 college savings plan that shelters additional investment savings for tax-free payouts to cover future college and private schools. So, everything focused here is for the folks with kids, and we'll get on to the other. Establish a Roth IRA for each employee child that you can contribute up to $3,000 a year. While these contributions aren't deductible to you, all future earnings will be tax-free when they're withdrawn at age 59 and a half. So that's just trying to give them a head up, trying to keep them debt-free when they finally get out of school, pay for their school, and give them a head up so they're not driving that slave work thing. Working all day, every day just to try to pay bills. I see that with the student loans as a big issue, but that's another day and a whole nother seminar. One of the things that you get into is you got to be careful with the kiddie tax. You get people who put stocks and bonds in their kids' names and lets that grow. In that situation, they can earn up to $2,100 a year of unearned income, which is basically stock investments. But then once over that, you end up paying a 15% tax on the gain on that. So, Congress created the kiddie tax to families from shifting their tax bill and all that income at a lower rate. So the IRS has seen a lot of rodeos, and they've tried to put little things in, but there's still lots of other options. You know, if you've got an FSA account, use it before the end of the year. It's a use it or lose it thing. A lot of people have them. It's money that you've set aside for medical expenses. You know, go get your physical, teeth fixed, blood work, whatever. That way you can get with all the holistic people. They can check your hormones, and you know, from the information you get from that, well, it's part of the process. And if it's money that's already set aside, use it, because you know, if you're healthy, you can go out and you can make more money, and that's really kind of the goal. You know, on the if you're itemizing your return, it's pretty simple. Instead of having a garage sale, clean out the garage. You know, make a list of those items that you document, that you donate to goods. Because if you make a list when you do your tax return, you can donate up to $4,999 worth of stuff. And it helps maximize your itemized deductions with your property tax, your mortgage interest, and also any sales tax on any cars, trucks, boats, or motorcycles that you buy, snowmobiles. So that's one of the things, because in this modern day and age, with interest rates being low, the deduction for mortgage interest and property taxes, sometimes there's not a lot of savings anymore in that type of deal. So the charitable donations in that really go a long ways. And what's funny is you can go onto the Salvation Army website, and they will give you valuations for just about anything out there. The funny thing is they give you about $1.50 to $2.50 for underwear. Now that's something you're not going to ever sell at a garage sale, but that's something that they give you as an evaluation. And that's where Bill Clinton got in trouble back when he was in office, because he wrote off some boxers for $12.50 a pair. And you know, well, it's Bill. He's an interesting character in of himself. Well, I don't know. I think they went with the blue dress or something. But you know, on the investment sides, you know, fund your SEPs, your IRAs. If you're age 50, do your catch-ups, your 401ks. Consider Roth conversions. One of the things is we have lots of financial people in this group. You know, I defer to them. They're going to be able to help you. You know, these are great things, but setting up a SEP and these IRAs, they can sit down with you and they'll be more than happy to do a consultation, help you figure out what fits your situation best. So, you know, look through the group, pick somebody out, and they can help you maximize that. You know, check with your minimum distributions. If you're old enough, or if you've inherited a IRA from an older parent, sometimes you have to take minimum distributions out of the account. Otherwise, you get a significant penalty for that. You know, and then, you know, and also if you know, because my parents liked buying stock when I was a kid, we'd get a couple shares of stock for Christmas. One of the things you got to be careful of is not buying mutual funds at the end of the year, because if you have dividend-bearing mutual funds, a lot of times they pay that out at the end of the year. So what you end up doing is getting taxed on that dividend for something that you already paid for. And so that can nail you a little bit there too. And then, you know, just kind of wrapping up, I mean, like I said, I've covered some simple things and some things that are a little more technical. But one thing is then invest in getting counsel for your business. You know, find a tax attorney, CPA, business coaches. Learn and understand your business, because that can help provide you tools to operate and be more organized and to stay on top of it. You know, look at the structure of your business. You know, is it time to convert to a S Corp or a C Corp or a partnership? Because there's a lot of other tax breaks that are out there. The more education you get about your business, the better business that you're going to run and the less taxes that you're going to pay. And, you know, I know Trump is the big guy out there, but he's got a fleet of people that helped him do complex taxes. And, you know, if you, as a business owner, you're taking risk every day. So if you're going to take that risk, you want the benefit for taking that risk. And that's part of what these deductions allow you to do. Take advantage of it. Build your company with it, and take care of your family with it.
Great.
Any questions?
Yeah, we've got time for questions, so.
Yes.
On the charitable donations, if it's goods, can you do that $4,999 at one time?
Sure.
Okay. So
Every
you don't have
year.
to piecemeal it.
No, what I normally do is I keep a box back in the office, and when I put stuff in it, I write a notebook of what I put in it. It's like, 4 t-shirts, 4 office wear, button-up shirts. I'm a little more technical about it just because I'm a tax guy. But, yes, sir.
Well, on the same lines, help me with this, but, I've gone through some major downsizing where I've purged a lot of stuff.
Sure.
And a lot more than even at the,
The full-
thrift store valuations.
Right.
Have gone over the $5,000.
You can do that.
That's, you still do that, right?
You can still do
Carry
that.
it over?
Well, you don't carry it over, you use it during that year. It just, there's a different form that you fill out for it. One of the things that there used to be a loophole when people would donate a car. They'd have a junker car and they don't donate it to ICANN Academy.
Right.
And they'd claim $10,000 for a $1,500 piece of junk. And so in those situations, they either want somebody to come in and evaluate, say like Brinker would donate a piece of art, or one of these other, large families, they donate a piece of art. In that situation, they want a valuation on it, so that way they can understand what market value is. And with the IRS, what you want to do is try to keep everything as simple as possible. So if you can document and work through it so they can understand it, it makes the process, if it ever gets looked at, a lot easier. Yes, sir.
For those of us that are more advanced in years, is there a limit on the time frame to establish an IRA or a Roth IRA?
Well, with a regular IRA, not with a Roth, you can get into it with, and that's where SEPs and other programs allow you at an older age. But a typical IRA, sometimes it can be a little more problematic.
So you wouldn't want to set up a traditional IRA if you're
Correct.
approaching 70.
Correct. Traditional IRA is probably not the right vehicle. But like I said, I defer to the finance guys on that.
You guys just start with the
70 and a half, you have to start pulling.
Right. You've got to take minimum distributions out of a traditional IRA, but with a Roth, you've got the flexibility that you can put the money in. And the nice part is you can pull out your basis without having a taxable situation occurring. Question?
Is there a max amount that you can give, like, to a 501(c)(3)?
Well, that'd be like a normal donation. I mean, you can even, for estate planning, some people have larger estates. You can give up to $14,000 a year for family that, and same thing can be with charitable. Once you exceed that, the IRS wants you to fill out a charitable gift form. And so, because you've got a lifetime limitation of what you can donate or give, and so the IRS wants to sort of keep track of that if it's over the $14,000 mark. Question? Yes, sir.
Regarding like the LLC and corporation, sole proprietorship, is
Yes.
there a threshold or some guidelines of when you should look at it?
That's a good question. It depends on, are you ready to go to that next level? I mean, a lot of times my definition is when I get a client that's consistently earning over $100,000 a year on a Schedule C as a self-employed person, because they're leaving a lot of money on the table because they're paying a lot more in their self-employment tax than they have to, and they're paying a lot of other expenses that the corporation could take care of. But when you get incorporated, it's more technical, and you have to get educated because it's a whole different mindset of running a self-employed Schedule C and running a LLC or S Corp, etc.
Okay.
Because what happens is, with the methodology when you're self-employed on a Schedule C is take everything and try to minimize your income totally. And one of the things is when you incorporate, a lot of those expenses that had come out of your pocket, the corporation can pick up for the family. And that's where you can pick up insurance, pension plans, the stuff for the kids. It can be very, very beneficial. But it's also, you have to get into that mindset and get the education. I get people who go, I'm happy this way. I was telling the story earlier that I've had a person that's come in and he started out with my dad and I've met with him 4 times. He comes in, he does 4 years worth of returns, puts it on a program, and then he doesn't come back for 4 years. And I've sat down and I've spent hours trying to lay out, here's how you can do it. And after the third time, he goes, this is how I'm gonna do it. And I go, God bless you. You know, if you're not gonna drink the Kool-Aid, you know, you pay a lot of penalties, you pay a lot of interest, you're paying me more than you have to. But if that's the way you're gonna do it, that's fine. You know, it's the way it is. And, you know, a business owner who, in Uncle Sam's pocket. And, yes,
On the healthcare.
Yes.
The 2.5% responsibility payment, so how do I help my clients understand, you know, how that goes on their taxes? And their
you mean on the self-employment, the Social Security, Medicare?
Yeah, the whole thing, because now it's a 2.5% responsibility payment if you do not have healthcare of some form of that.
Well, and that's,
There are all sorts of ways to get around that.
right.
Well,
So that's.
And depending on this election, that could be a mood issue. I mean, that's a whole different bailiwick with Obamacare and things of that nature. You know, a couple years ago, I talked about if you get into the program and you get into the exchanges, it's a never-ending deal. Every time there's a life change, every time you get a raise, every time you lose a job, every single time you have to reapply in the exchange. And I utilized an issue where there was a family of 4 that the husband got a $10,000 raise. At the end of the year, when he did his taxes, it cost him $12,000 because the supplement was offset. And I'm not a participant in the exchange, and there's a lot of other options out there. But hopefully, once the elections get done, this will be clarified quite a bit.
Yeah, because it's like trying to help them get something that's not on the exchange right now, because there's only 2 companies on the exchange.
And everybody's bailing out of the exchange. It's, you know, the concept is good, the implementation is just horrid. But any other questions? Yes, ma'am.
Yes, HSA health savings accounts, is there, can you carry it forward for the following year, or you have to spend it the year that you?
Well, the FSAs, you have to use that year. The HSAs, yes,
The HSA, you can carry it forward?
yes,
No tax penalty, or,
no,
okay.
yeah, just the FSAs. Anything else?
Okay.
Did I answer everybody's questions? I mean, or did I create more questions than I answered?
Let's give. Okay, as with any of these things, say goodbye to everybody. See ya. See you the next time. Okay.